Welcome back to the deep dive. We take all the noise, all the data today, it's the absolute chaos from the crypto markets yesterday, and boil it down to what you really need to know. And hey, for everyone tuning in, this is actually the 131st edition of our CryptoFlash Daily Review. Big news though, this is the very first one we're doing in English, so welcome aboard. Today, we're diving deep into November 4th, 2025. Look, this wasn't just a down day for crypto. We're talking a major turning point, just a sudden, really violent crisis of confidence across the board. Our mission, as always, is to figure out how this tangled mess of, well, internal crypto failures, real systemic stuff, and these big external economic pressures crash together. How did it create this cascade? Okay, let's unpack this. It was a brutal sell-off, lots of fear, lots of forced selling.
Yeah, what's really interesting is this was like the ultimate stress test, wasn't it? Not just a slow bleed, it was fast, painful, all that excess leverage just unwinding.
Yeah.
And it really tested the foundations, you know. The whole sector got hit by problems from inside and outside all at the same time.
Okay, let's start with the damage report. The numbers.
Yeah.
They're pretty staggering.
They are.
Even before November 4th, the total crypto market cap had already dropped over $400 billion. By the end of the 4th, it was sitting at $3.45 trillion. That's down almost 4% on the day itself.
Yeah, that's a huge number on its own.
But the real psychological hit, the one people felt, that was Bitcoin.
Oh, absolutely right. I mean, the emotional damage for short-term holders, probably irreversible for some. During the day, Bitcoin actually dipped below $100,000.
That crucial level.
Exactly. And that level had held firm for, what, 180 days straight? Quite remarkable.
Yeah, $100K felt like an institution almost.
Yeah.
Seeing it break, even for a moment, must have sent, well, shockwaves everywhere.
It definitely did. BTC managed to settle back around $100,893 after the worst of it, but touching $96,794. That just confirms serious weakness underneath. A mass technical breakdown.
And when Bitcoin catches a cold.
The altcoins get pneumonia.
Yeah.
Yeah, this time was no different. Really shows you how intense that deleveraging pressure was.
So tell us, what happened across the rest of the market when that Bitcoin support just vanished?
We saw huge drops, well, everywhere. Ethereum plunged 6.01%, finished the day around $3,490.
Wow.
And you gotta remember the context here. That single drop wiped out all of Ethereum's gains for the entire year. That fundamentally changes the story for ETH, doesn't it?
Ouch. Yeah, erasing a year's worth of gains in one day, that screams capitulation.
And the others just followed. Solana down over 9%, BNB fell 7.31%, Cardano dropped 6.60%. It was just indiscriminate selling across all chains. It shows how linked everything is, the liquidity pools, and maybe more importantly, all those leveraged bets.
You know, I always find it interesting in these moments, you still see these weird little pockets of speculation, right? Even when the main market's burning down.
Sure.
While the big names were crashing, you had tokens like DCR surging 142%, Kite up 127%, DSH climbing 66%. What does that tell us?
It just confirms that, yeah, even in a total crisis, that retail speculative urge, it hasn't totally disappeared. These are often, very localized pumps, kind of disconnected from the big picture.
Right.
Shows that chaos is never really uniform. And there's still a high risk appetite in some corners, apparently.
Okay, so we know how bad the damage was.
Yeah.
Now let's get into the why. This is where it gets really interesting, I think. Because it wasn't just, panic selling because of headlines. It was a systemic failure, starting right inside crypto itself.
Exactly. The whole market stress test really kicked off in DeFi. Decentralized finance, that's where the systemic risk really showed its teeth through some critical failures. And it exposed these deep problems with how debt gets managed, how collateral is treated in the DeFi space.
And the biggest example was the stream finance collapse, right? Walk us through that. More importantly, why did that failure matter so much?
Okay, so the crisis really started bubbling up on November 3rd. Stream Finance disclosed this huge loss, $93 million, managed by some external fund. The immediate result, their stablecoin XUSD, just violently depegged, crashed over 70%, down to like 32 cents.
Wait, hold on. $93 million loss is big, sure. But why does that trigger a $400 billion market crash? What made Stream so infectious?
It was the underlying structure, their reliance on rehypothecation.
Okay, break that down for the listener. Rehypothecation.
Yeah, basically it's like stacking loans on top of the same collateral. So you take your Bitcoin, you lend it out. The person who borrows it uses that Bitcoin as collateral for another loan, and maybe it happens again.
Oh, okay.
It makes capital super efficient, right? You get more bang for your buck. But it creates these incredibly interconnected and fragile lending loops.
So like a house of cards, one gust of wind.
Precisely. If the original asset value drops or the fund managing it messes up, like with Stream, that failure just ripples instantly through every single protocol that's linked in that chain.
So a small loss somewhere else becomes this huge black hole of debt.
Exactly right. The total debt exposed to Stream's failing assets was almost $285 million. And that directly hit other protocols, like Elixir, for instance. They had 65% of their DUSD stablecoins backing lent straight to Stream.
Wow. So Stream goes down, Elixir stablecoin is suddenly in deep trouble.
Instant solvency crisis, yeah.
And just to pour salt on the wound, while the market's trying to deal with that mess, we get the balancer protocol exploit happening at the same time.
Yeah, concurrent disaster. This was a really sophisticated attack. The estimated loss was over $120 million.
$120 million on top of Stream.
Yep. And the attackers used this vulnerability. It was called a rounding down precision loss in Balancer's V2 composable stable pools.
A rounding down precision loss. Okay, that sounds super technical. In plain English, what does that tell us about DeFi security, especially since Balancer had, supposedly been through extensive audits?
It tells us that complexity is still the biggest enemy of security in this space. You've got millions of lines of really complex smart contract code.
Right.
And even something that seems tiny, fundamental almost, like how a calculation rounds a decimal point, that can be exploited to drain huge amounts of money. It just highlights this ongoing basic risk, even in the so-called blue-chip DeFi protocols. Audits help, but they're not foolproof. It's a risk the market just hasn't fully solved yet.
So you had add up Stream, Balancer, and there was a smaller Moonwell attack, too. Those internal crypto failures basically wiped out, around $222 million just in the first few days of November?
Approximately, yeah. That's enough internal damage on its own to really set the stage for a wider panic.
Okay, so that internal crypto chaos created the fragility. But the final push, the thing that really tipped it over the edge, seems to have come from outside crypto entirely. Let's talk about that external storm, the macro factors creating this global risk-off mood.
Yeah, the primary pressures hitting the market right as DeFi was blowing up were very much U.S.-focused. First, you had the ongoing U.S. federal government shutdown, which was, historically long at that point.
Right, the shutdown. How did that impact crypto?
Well, it raised real worries about liquidity because it delayed the Treasury General Account, the TGA drawdowns.
Okay, help us out here. TGA drawdown. Why does delaying that matter for, say, Bitcoin's price?
So the TGA is basically the government's main checking account held at the Federal Reserve. When the Treasury draws down funds from that account, that money usually flows out into the financial system. More liquidity.
And liquidity is generally good for risk assets like crypto.
Generally, yes. So when the shutdown delayed those drawdowns, the market saw it as an immediate, even if temporary, tightening of liquidity in the system. Less cash sloshing around.
Okay, that makes sense. But hang on, didn't the Fed just cut interest rates recently? Wouldn't that normally inject liquidity and be bullish? Was the TGA shutdown thing really a bigger deal than the Fed easing?
That's a really sharp point. And normally, yes, the Fed action should have been supportive. But this time, it seems the immediate fear from the TGA liquidity freeze, combined with some pretty bad economic data, that just overwhelmed the longer-term optimism from the rate cuts.
What data are we talking about?
Data showing the U.S. manufacturing sector was contracting. For the 8th month in a row, that just reinforces fears about slowing growth, pushing big money towards safety.
And that flight to safety wasn't just contained, right? It spilled over into other assets.
Oh, absolutely. Weakness in, say, AI-related tech stocks triggered broader de-risking. The NASDAQ fell over 1% that day, and that directly impacts investors who play in both tech stocks and crypto. If they're getting nervous and selling risk in one volatile area, chances are they're selling it in the other too.
But as you kind of hinted at before, analysts weren't saying the sky was totally falling, were they? There were reasons not to panic.
They weren't, no. We have to see the nuance. Even with all the chaos, analysts were pointing to those positive factors still in the background. That recent Fed cut, real progress on the U.S.-China trade deal, those were still seen as bullish anchors longer term.
Yep.
You saw commentary like from the Kobesi letter saying, essentially, yeah, the short-term technical picture looks broken, but the long-term fundamental reasons for holding risk assets still strong. The message was kind of, hold your nerve, don't get spooked by the daily noise.
It's crucial, though, to step back and realize this whole meltdown happened while digital assets were actually becoming more embedded in traditional finance, right? More institutionalized.
Yes, exactly. It highlights this unavoidable integration.
So what does all this turbulence mean for crypto's long-term path?
It confirms that regulation isn't optional anymore. It's just It's an irreversible trend. The market's growing up, but that means dealing with government oversight, often driven by geopolitics.
Like the sanctions we saw.
Precisely. The U.S. Treasury's OFAC sanctioned 53 crypto addresses linked to North Korea's Cheil credit bank. That's serious stuff.
And it shows crypto is now firmly on the radar as a foreign policy issue.
Absolutely. It was a direct response to estimates that North Korea-linked hackers stole something like $2 billion in 2025 alone. Funds apparently used for, well, WMD programs. And beyond just enforcement, you're seeing the structures for legitimacy being built. Landmark regulations.
Like MiCA in the EU and the Genius Act in the U.S. We've talked about these before, but remind the listener, what do they actually do?
These are huge global steps. MiCA in the EU is fully up and running now. Any crypto firm operating there needs proper licenses, has to meet strict standards. It's about building trust.
Okay. And the U.S. Genius Act.
That one's laser focused on stablecoins, making sure they have strict one-to-one backing, mandatory disclosures. Basically trying to prevent another XUSD style collapse by killing off fractional reserve stablecoin.
And speaking of stablecoins and integrations, nothing really shows that connection to traditional finance better than the absolutely mind-boggling scale of Tether, does it?
No, it really doesn't. You just have to look at their Q3 2025 report. They revealed they held around $135 billion in U.S. treasuries.
Okay, put that in perspective. $135 billion.
It makes Tether the 17th largest holder of U.S. government debt in the world, right up there with actual countries.
Wait, seriously? 17th largest? That changes everything. They're not just a crypto company anymore. They're a systemic piece of global finance.
That's the real takeaway. Centralized stablecoins like Tether, they're simply too big for even central banks to ignore now, and their profits show at over $10 billion year to date. That's serious financial muscle.
Okay, so we had DeFi blowing up internally, we had bad macro news externally, and this backdrop of crypto getting tangled up with global finance and regulation. But why did this sell-off turn into such a violent cascade? We need to look at the internal market structure specifically.
Leverage, right?
That's the essential amplifier. Leverage was just at unprecedented levels leading into November 4th. Think about this. Before the crash really hit, we were seeing something like 300,000 traders getting liquidated every single day.
300,000 a day, wow.
Yeah. So when the price actually started falling seriously, all that debt acted like rocket fuel. It triggered this massive automatic domino effect of forced selling. That pushed the price down way faster and further than just regular spot selling ever would have. And the specific numbers from November 4th itself, they're just brutal. They really show the speed of the pain.
Oh, they show extreme pain. Over $1.1 billion in leveraged crypto positions just wiped out in 24 hours.
$1 billion.
And the most intense moment. For Ethereum longs, $287 million evaporated in a single hour. That speed, that just shows you the destructive power when high leverage meets bad news.
And that kind of wipeout just sends psychology spiraling, doesn't it? Yep. We saw the crypto fear and greed index crash down to 21. That's extreme fear.
Yep, lowest reading since way back in April when Bitcoin was under 75K. It reflected pure panic, capitulation, mostly among retail investors, you know, just selling at any price because that $100 case support broke.
But here's the fascinating part. Amidst all that retail panic, the on-chain data showed something different happening with the whales, the big players.
It's the classic contrarian signal, isn't it? Retail is freaking out, selling everything. Well, the so-called smart money is making moves. We saw one whale close out a massive 66,000 ETH short position, locked in over $24 million in profit. Perfect defensive play.
Nice trade.
But maybe more telling, another whale pulled 110,000 ETH off an exchange. That's worth, what, $386 million? That usually suggests they're planning to hold it long term, not sell.
Interesting. So whales accumulating while retail panicked.
Well, yes and no. Whales were definitely strategic. But interestingly, the data also showed retail investors, despite that extreme fear reading, actually kept accumulating ETH during the dip too. So maybe not total retail capitulation, a bit more complex.
Okay, so we're left with these conflicting signals. You've got the undeniable bearish technical picture. Bitcoin breaking $100K is bad, no way around it.
Right.
But then you have these powerful, longer-term bullish things happening, like growing institutional interest. That new Solana ETF pulling in over $400 million in its first week, that's significant.
Yeah, institutional analysts are definitely trying to make sense of that split. You had Matt Hugin from Bitwise saying that retail hitting maximum desperation might actually be this signal that we're near stabilization. Basically, peak fear is often the best time to buy.
But the technical charts are still flashing warning signs, especially for Ethereum.
They are definitely still cautious. While some think the bottom might be close, technical analysts like Ali Martinez threw out a pretty scary scenario, Ethereum potentially falling to $1,700 by mid-2026.
Gross. $1,700.
Yeah. Though Marcus Thielen from 10x Research offered a more near-term view, saying the next likely support zone for ETH was probably around $2,700 to $2,800. The main consensus: volatility isn't going anywhere soon.
Okay, so for the listener trying to navigate all this, what are the absolute key takeaways from the chaos of November 4th? The things they must keep in mind?
Okay, three main things. First, leverage is the systemic amplifier. You have to understand. The wild swings, the volatility, it's mainly driven by the derivatives market now. Futures liquidations matter more than spot selling. If you track one thing, track open interest in futures.
Got it. Leverage drives the bus.
Yeah.
Second, related to the DeFi blowups.
DeFi's immaturity requires rigor, stream, balancer. They prove these contagion risks are very real, especially with things like rehypothecation creating hidden links. If you're putting money into DeFi, you absolutely have to do serious homework on the protocol's security and how its collateral actually works. Non-negotiable.
Makes sense. And the third key takeaway, the bigger picture.
The regulatory trajectory is set. Look, regulation like MiCA and the Genius Act, it's happening. It's irreversible. Being compliant isn't just a cost anymore. It's actually becoming a competitive advantage. It's what unlocks the door to serious institutional money and prepares assets for deeper integration into global finance. Look, the November 4th crash, it really just highlights how the market is maturing. It's messy, it's painful sometimes, but it's a transition, right? Away from just pure speculation towards something more integrated, but still very volatile. Success, I think, will come to those who can handle both sides of that coin, the amazing innovation and the very real systemic risks.
So let me leave you with this thought. We saw the Fear and Greed Index hit rock bottom, extreme fear, lowest in months. At the exact same time, we saw whales apparently starting to buy ETH again. Now, if retail capitulation is supposed to be the ultimate contrarian buy signal, is extreme fear actually the best indicator we have in crypto right now? Something for you to chew on. That's it for this deep dive. Stay safe out there, stay informed, and we'll talk to you next time.